Hello, everyone. My name is Brenda Lewis with the Tulsa Regional Chamber. Welcome to this segment of the Build Program, which is a series of webinars aimed at providing education and resources to small business owners and their growing team of leaders. The presenting sponsors for the Build Program are the Persimmon Crew. The presenting sponsors for the Build Program are the Persimmon Group and Security Bank. Thank you so much to these sponsors for making the Build Program possible. An additional thank you for their generous support is to our small business benefactors who support and make the program of this work possible for the Small Business Connection. Those are Blue Cross Blue Shield of Oklahoma, Exceptional Leaders Lab, Stride Bank, Southwestern Payroll, and TEDC Creative Capital. Today's segment of the Build Program is entitled Financial Fitness, which will feature the expertise of Denise Felber, CPA and tax partner at Hogan Taylor. Denise, thank you so much for joining us. I'll now turn it over to you.
Thank you, Brenda, and thank you for taking the time to listen to a little bit that I'm going to share with you. Hopefully, some of it's useful and you can integrate it into your business plan and your cash flow model. Taxes you can't avoid. You might try, but you're not going to avoid them. You need to understand the risk and the rules. We can minimize the effect on your budget, but we need to pay attention and we need to understand how it could affect your business. In the next slide, we talk about budgeting. In budgeting, you make the assumption as to what you're going to spend and when you're going to spend it. You're going to have income taxes, you're going to have payroll taxes, you're going to have property taxes. You're going to have several lines labeled taxes. And then you got deductible expenses. Those are important because they help reduce your tax base. What you don't want is to kill your budget. Budget killers are things that you can't expect, you can't deduct, and it makes you cranky because you did it and you could have avoided these items. Penalties and interest are a budget killer. You can avoid them. They can be extremely high. And if they're bad enough, you can have criminal charges associated with them. And that is, of course, non-deductible and gets very, very expensive on your budget and in your cash flow. The next thing we want to talk about is the number one rule that I tell business owners. You never, ever, 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 ever use somebody else's money to pay your bills. If you collect money from vendors, from employees, for anything that you have to remit to a retirement administrator or to a taxing agency, that's not your money. You are an administrator. You have a fiduciary responsibility to remit that money timely. And if you don't, fiduciary responsibilities are going to cause massive penalties. For payroll taxes, it's 100% of the amounts that you don't remit according to plan. You can also have this with your FICA taxes, your deferrals that your employees have you withhold from their paycheck, and also just the plain FICA income tax withholding and other withholding that you show on somebody's W-2 or pay stub. Remember, this is not your money. I would put it in a separate bank account so you can prove and remind yourself that money isn't available to pay bills or pay vendors. You have to keep it or protect it so that you can remit it to the proper person at the correct time. The next one that we want to talk about is documentation. You have to have books and records. I tell my clients, it's like you're building a story. And if you have all the details in place, you will have a better story. You have something somebody can look at and understand what's going on. If you do it timely, your story's going to be better because you will have more detail. You'll remember why you did it, when you did it, and what it was for. You need to have those records. You need to keep them timely. And I mean, once a month at a minimum, not once a year. If you have benefit plans or accountable plans, you also have to have that information in writing and have proof that you shared this with your employees. The next thing we want to talk about is your audit risk. As a small business owner, the biggest audit risk you got is you as the owner. The IRS agent, starting with their first information request, are going to look for your personal expenses in your books and records. They want to see that you keep your personal expenses separate from the business. If you go buy Subway sandwiches every day and get a sandwich and charge it on your credit card for the business, they know that's personal. You want to have that bank card or credit card for the business separate from your personal, and make sure that you use the proper card as you're taking care of your daily business. There is no such thing as 100% business on using an automobile. The business can own a vehicle, and if it's sitting at the shop, except when errands are being run, it'll probably be 95% business, because I'm sure there was a time or two you ran to the grocery store. If it's your personal vehicle, then obviously it can't be 100% business. They will be looking. There are apps, there are great apps out there that help you keep track of your business mileage. Or you can do a plain old paper log, but you need to do it on a timely basis. You will catch more business files if you do it on a timely basis. The other thing they're going to look for is, how do you get money out of your business? You need to. This is your job. This is your livelihood. If you have a corporation or an S Corp, you can have a salary, and I would recommend you do have a salary. Take the money out, pay the FICA, have the income taxes withheld, and that is the money that you're getting from the company at reimbursement for your time. If you have a partnership, or if you have a sole proprietorship, you cannot pay yourself a salary. That's a common mistake, but you can't. What happens is, if you've got a partnership or sole proprietorship, you pay money on the net income from that business. And net income is before any of your draws. So if you have $100,000 in net income and you've taken $50,000 out for your living expenses, your net income that you're paying taxes on is $100,000, not $50,000. You need to be aware that draws, if you've got a balance sheet and a profit and loss statement, draws are not a profit and loss item, and they do not reduce your taxable income. The other thing I want to mention, and it is something that they look at very closely, is loans. You loaning money to the business isn't a problem. The business loaning you money is, because they're going to assume or try to promote that the loan is really compensation that you're taking out of the business. You want to document the loan. You want to have the proper interest rate. You want to have a payment schedule, and you want to follow the terms of the note. If you can get away from borrowing money from the business, I would do that. I would go to the bank and borrow the money there if it's possible. It will save a lot of issues if you become subject to an audit, and they will, the smaller the company, the more tightly controlled the company is, the more they're going to look for personal expenses. The next thing we want to talk about is forms. there's a whole lot of tax forms. And this is not the entire list, but I want you to be aware that any form or payment that's shown on the form that's late is going to cause you to be subject to penalties and interest. And they can be quite extensive. Again, if it deals with fiduciary items, it's going to be more expensive. You're going to have payroll taxes. You're going to have your 940 and 941, which is the way you remit income taxes and FICA taxes that have been withheld. You're going to have income taxes at the entity level if it's a corporation. If you sell goods, you're going to have sales taxes. You're going to have property taxes if you have a location, furniture and fixtures. Your license, if you're licensed, if you're a doctor, if you sell alcohol, whatever it is, those licenses have to be renewed on an annual basis, and you have to keep track of them. And then you have to be registered with the state. That's very important. You want the state to know who you are and where you are. And you, for example, in Oklahoma, if you have a limited liability company, it's only $25 a year. But if you don't pay it, then you're out of compliance. And when somebody looks you up on the state website, you are no longer in compliance, and that's not good if you want to keep doing business and have your new customers go and look you up. The next thing we're talking about is employee benefits. Employee benefits are a way that you can retain employees. If you can offer one employee something different than the business next door to you, you have a better chance of keeping them. The benefits you're providing are going to be deductible to you, but if you do it right, they're not wages to your employee, which means you don't have to pay payroll taxes on those amounts, but you've got to document, and that documentation has to be in writing. When you have employee benefits, you've got to set it up correctly. Once you get everything set up, it works, and you just keep following that pattern or that rule. It's just make sure you get them set up from the beginning. Don't let it be a casual conversation. Provide paperwork to the employee. They know what the rules are. The next thing we're talking about is the actual written plans. You have retirement plans that have to be documented. You have accountable plans, and accountable plans mean that you can give money to your employee, and it's, again, not wages, but you can take a deduction. They don't have additional income, and there's quite a few. I listed some of the ones that most of you would know: the per diem, the mileage reimbursement, expense reimbursements, cafeteria plans, and we've got a strange animal called a QSE HRA, and we'll talk about that here in just a few slides. But you need to know about these. It's kind of like picking which one you think your employees could use the most and would make you more attractive in employee retention. On retirement plans, you need to know the rules. You have to set up the plan. You have to understand discrimination. If you have employees, they have to be covered by the plan. Now, you can have limits that says they have to be an employee for a year, or they have to work over 24 hours a week during the year to be subject to the retirement plan. You have to know when you can fund these and how much you can put into the plan. Then you have the additional consideration: did the employee contribute to the plan also? You need to be aware of the rules, of the amounts, of the timing, and how do you report these. The retirement plans, if you have no employees, which is the next slide. If you have no employees, it makes it easier because you don't have to cover anybody else but yourself. There's one called a solo 401k. You have to set it up with an administrator, normally a brokerage house. You can put your first $19,500 of net income into the plan and get a deduction. So you actually end up at zero if you only make $19,500. If you make more than $19,500, you could put in the $19,500 plus 20% of your net income up to $58,000 total. This is a benefit. It's a good planning tool because you don't have to put in the profit sharing or the amount between the $58,000 and the $19,500. You don't have to put that amount in until you file your business tax return. So it allows you time to do a little bit of post year-end planning, and it allows you to accumulate the cash to make the payment. There's something called a SEPA IRA, which is easier because you don't need a plan administrator, but you're limited to 20% of net income up to the $58,000. Now, if let's say you have $100,000 of income, net income. If you have a 401k, you could put in $19,500 plus 20% of the $100,000. So you can put in $39,500. If you have the SEP IRA, you can only put in $20,000. When you're setting these up, you have to think about, do I want to maximize my retirement? Do I want to keep more cash available? But when you set up the plan, this is the type of things you think about. You are not required to put money in either one if you're the only person or employee of your business. And of course, we always have the traditional Roth or IRA. Today, the IRS announced that they're letting us put more money into our 401ks. We can put in $20,500 instead of $19,500, and we can put in $61,000 instead of $58,000. And that's going to be for the year 2022. Again, this should help you in your budgeting and your planning. That's a benefit because it lets you take money out of one pocket, put it into the other, and get a deduction. That's a win for taxpayers. If you have employees, there are rules called discrimination. If you've got an employee and you're setting up a retirement plan, your employees have to be covered because, of course, you want to be covered. There are rules about matching. If you have employees that are putting in money, you would be required to put in 3% to match their contribution up to 3% of their salary. Or you can just put in 2% for all the eligible employees, whether or not they have a salary deferral. On the 401k, the employees can defer $19,500. Now that's going up again to $20,500. There's something called a simple IRA, which is a little easier to fund. And that amount is going up to, I think it's $14,500. The SEP IRA can only be funded by the employer. So the 401k, the employee can contribute. The simple IRA, the employee can contribute. The SEP IRA, the employer is the only one that can put money into the account. The 401k, the employer could put money in because of the matching rules and the safe harbor and get it up to $58,000. The simple IRA, unfortunately for that, you can get the deferral part that the employee put in plus the 3% match or 2% safe harbor, but you can't work it up to $58,000. If you have employee deferrals, you are fiduciary and you have to get those deposited immediately. There is a time limit. 3 days to 30 days, but I would say that's not your money. Put it away and don't worry about it. That's again a fiduciary, and the penalties for not doing that are terrible. The next thing let's talk about is accountable plans. The IRS sets the limits, and for per diems and mileage, they set them once or twice a year. Right now, we have a mileage rate of 56 cents a mile, and we have per diem rates for your travel. Your employer can reimburse you for meals, incidentals, and or lodging, and the per diem rates change based upon what the employer wants to cover. These are the maximum. Your employer doesn't necessarily have to pay 56 cents a mile, but the employer you're competing against for those same employees are going to pay 56 cents a mile. So you need to stay current, and you need to know where to go find those rates, or have a good accountant that'll tell you when they change. The other thing you can do is do expense reimbursements. If the employee goes and picks up a computer for you for the office, and they pick it up and bring it in, they give you a receipt. Well, because they give you a receipt and you've got a plan that says, I will reimburse my employees for any expenses they incur on the business behalf. They get paid for the computer and the mileage that they incur to go pick it up. There are things called cafeteria plans, and I think most of us have been exposed to those. You need an administrator. They can cover health and childcare. They can cover life insurance and disability insurance. They can cover one of these special plans, the health reimbursement plan that we have. Some of these items get funded by the employer. Some of these items are discretionary by the employee, and they put them into their account to be used for the tax year. Again, this is a fiduciary amount, and it's kind of like a bookkeeping entry, but that's the employee's money. So you need to make sure you've got money available to reimburse the employee if they incur certain expenses and they submit it in writing or through some electronic media. The next thing we want to talk about is the strange one, the QSEHRA. It's a qualified small employer health reimbursement account. Before the Affordable Care Act, employers could reimburse employees for certain medical expenses. And if you're a small employer, that was a benefit because you couldn't offer group medical insurance. When the Affordable Care Act came in, they wanted all employers to offer group insurance. So they said, no, we can't do this anymore. You can't reimburse. The last couple of years, they changed their mind and they said, if you've got less than 50 employees, you can set up a plan where you reimburse your employees for health costs. And it's either $5,300 for singles or $10,700 for the family. As long as it's a medical cost, it can be the health insurance where you go out to the market and you want reimbursed for your premiums. It could be for drugs, it could be for hospital, it could be for your deductible. Anything that's medically related, you can be reimbursed up to these amounts, and it's not counted as wages. This is a very beneficial item for small employers. It kind of helps them offer a similar package to their employees. It just has to be in writing. That is the main thing I'm trying to impress, is that a lot of these things you can do for employees, as long as it's in writing and you follow the rules, you can do a lot to retain that employee and help them out in their daily lives. The next thing we want to talk about is how the law changes. I used to have a partner. He was so smart. He would sit down with a red cheap tablet and do tax planning with clients. They would scratch out what they thought their income would be. And he knew those tax tables enough that he could go in and calculate what they would owe within $100. That's not the world I live in. The tax law changes almost annually. There's always a change. They make a new announcement. They clarify something. They have phase-ins, phase-outs, or you get the Congress and they pass a tax act in December. That's their favorite time to pass tax acts. We've had 12 tax acts in December in the last 20 years. An example of that is bonus depreciation. If you buy equipment, you deduct that over its useful life. And the IRS will tell you what the useful life is. And it could be 3 years, 5 years, 7 years, 9 years, 15 years. Bonus depreciation provisions say if you buy a fixed asset, you can deduct 100% of the cost in the first year, which is good because it's possible you financed it, you haven't even paid all the money out, and you get a deduction for the entire amount. That's bonus depreciation. And right now in 2001 and next year in 2002, that applies to 100% of the cost. 2003, the rules change. Instead of getting 100% of the cost in the first year, you get to write off 80% of the cost, but then the other 20 you've got to deduct over its useful life. And as you can see, 24 to 25 to 26, it keeps dropping. And in 27, the rate is 0. Now, you can still depreciate it. It's just the speed in which you can take the deduction. In the last 10 years, bonus depreciation rules have changed. Sometimes the bonus depreciation is only 50%. Sometimes it's only for new property, not used. Right now it's new and used, but just be aware those rules change. You cannot try to remember it and say, oh, I know this rule. It's going to change every year. Just be aware, do some reading or checking with your accountant to confirm what the new rules are going to be going into the new year. Let's talk about incentives. The governments collectively want you to hire people, and they want you to build infrastructure. They want you to build buildings. They want you to expand. The federal government has a lot of incentives. If you want to hire an underprivileged group, that's the workers, the employee, the EEOC. If you want to build a building and you put in lights in a different manner or have a stronger insulation on the interior, you can get credits for having energy efficient property. The state of Oklahoma is the same way. It wants you to bring jobs to Oklahoma, and it wants you to build in Oklahoma. And the Department of Commerce is a very good site for that. Locally, there are some waivers that they can do. In the town of, or in Tulsa, Oklahoma, if out-of-state people move to Oklahoma and work remotely with their employer who's out of state somewhere, the city of Tulsa and one of our local charities will pay them to live in Tulsa. And at the county level, you've got the Freeport exemption, which lets you not pay property taxes on certain types of inventory. There are also incentives if you build a building that you can get a waiver on property taxes for a certain amount of time. You need to be aware of this. You need to talk to people. It will take you some time, but it's important to learn if you would do it one way versus the other. Can you save tax dollars? The next thing I want to go over is my reminders, my stressors. Never use somebody else's money to pay your bills. The employee money and the government money needs to be locked down, and you will save so much headache and penalties and money if you follow that one rule. And the other thing is file timely. If you file timely, you still got to pay the tax, but you're not incurring penalties and interest, which is the whole purpose of being aware of what's due and when. I had some resources that I listed on the next slide. The IRS website has a place for small businesses, and it has probably 30 links. And it's got things about what is a self-employed person? What are the various retirement accounts that you can offer? When are taxes due? It's a great beginning website. It is a place to go learn. Obviously, you're going to have to ask more questions, but it is a good website to start with. There's something called Tulsa Score here in town. It's retired business executives that'll help you do business plans and budgeting. The Oklahoma TAP website is a place where you can go and do a lot of paperwork and pay your taxes, pay the sales tax electronically where you're not filing the paper. When you used to start business in the state of Oklahoma, there was a form you'd fill out, and it was about 11 pages long, and it had all these boxes you had to fill in. Where are you going to sell alcohol? Where are you going to sell cigarettes? Where are you going to have employees? What's the nature of your business? What's your employer ID number? Took a while. You can now do it electronically on the screen. And they also have help desk available if you had questions, but it's a much easier process than what it was. They also have at the oklahoma.gov website, they have a new business center. Again, it's a resource to go in and see what the state wants you to do, but also what are some of the incentives. The irs.gov also has a particular section that covers the retirement plans. Again, it's a great one. You need to end up going to an administrator or a broker, but this gives you the basic parameters, the maximum amount of money that you can put in, and can your employees participate. The Oklahoma Department of Commerce, I've worked with several times. They're free. They are aware of the incentives that the state offers, whether it's credits or tax waivers. They will help you fill out the forms. They will help you qualify and make sure that your business plans will fit the parameters. They do it for free. That's a very good price for going through all the paperwork and the weeds of the state legislation. My name's Denise Felber, and I'm a partner at Hogan Taylor. At Hogan Taylor, we do have a website that we post information that we think would be useful to our clients and our friends and family. And you can actually ask questions through the website if you have just a general question, and one of us will get back to you from the tax department. That's what I'm sharing with you. Good luck on your new business. I hope it works. And I hope that the only money you give to the government is their fair share and none of that nasty penalties and interest. Thank you.
Thank you so much, Denise. And we actually now have some time for some Q&A if you are up for that. So what is one mistake that is simple to fix?
The simplest to fix is you move and you don't tell anybody. There are forms with the state, with the federal. Send in the change of address forms. It's a specific form. It's not the US Post Office form. It's a government form, because if they send you a notice, if they tell you you're getting audited, if they send you a check, it's not their responsibility, it's yours. And you could end up having a penalty notice and you don't get it before your time has lapsed and you have no rights to appeal. So make sure you file the change of address.
That is very helpful. Another question on what you covered with us today. What is one thing that you can do to protect yourself?
Hire a payroll service. Hire a payroll service. They are bonded. If they withhold the money and pay your employees, they have to also pay the amounts they withheld. And if they miss the deadline, if they use the money improperly, it's not you, it's them that are going to pay the penalties and have to take care of the IRS. It's doing payroll is a pain. It's a lot of detailed work. And of all the jobs that I would pass off as a business owner, it would be that one. That one doesn't cost much considering the amount of time it's going to take you to do it.
Thank you for that. And wrapping up here on our questions, what is the difference? Maybe some of our small business leaders are facing with this now. What is the difference between an employee and an independent contractor?
An independent contractor, if they come in and they fill out a W-9, and they give you a sheet of paper that says they've got workman's comp, you hire them for a job, they say, well, I'll be here at noon. And they come in, they do the job, and they invoice you. They have control of their schedule. They have their own insurance. It's the people that you hire and say, okay, we're going to be cleaning a building Monday, Wednesday, and Friday. I need you here at 6 o'clock. You're going to work to 12 o'clock, and here's your cleaning cart. That person's an employee. You're controlling their schedule. You're telling them where they've got to be, and you're providing the supplies they need to do the job. There's a 14-part test that the IRS has. It's out on their website, but it really has to do with control. The more that you as an employer can tell them when and how they're going to do something, the more likely they are an employee. Plus, they can be paid as an independent contractor, and then they can come back to you and say, oh, you know, under Department of Labor rules, I'm really an employee. You owe me overtime. So you want to make sure you clarify it, and it also affects your retirement plans.
That is something that I'm sure many face every day. And so thank you for your deep insight on that. And my last question I really wanted to touch on is the QSEHRA plan. That's easy to say, isn't it?
Yeah.
Oh, how popular is this plan in general and in Tulsa?
With my clients, as soon as they find out about it, they sign up. It is not talked about much. But it's a matter of, most of them, it's a one-page document that says who's covered and how much you're going to pay. Especially if your wife works for you, if it's, you know, you and your kids, or it's you and two other guys and you want them to work with you, but you can't give them medical insurance. It's very popular. It's just not very well known.
And I know you mentioned this, but if folks wanted to find more information on this plan, where do you suggest they go?
IRS.gov. It's a wonderful website. It's not going to fill out your tax return for you, but it gives you a lot of information so that when you start asking questions, you're more informed. You don't need somebody to educate you from the first step. And it just helps meetings go better if you know where you're going.
Easy enough. Denise, thank you so much for your time today. And that wraps up our time that we have for today. Thank you for serving as our expert on this for this session of the Build program called Financial Fitness. Again, thank you to our generous sponsors who made today possible, and to our viewers, thank you for joining us. We hope that this session provided you with knowledge and insights to better support your small business now and in the future. Please check out our future segments of the Build program on our website or on our YouTube channel. We'll see you next time. Thank you.